Amazon is paying zero in federal income taxes.
Major development involving Donald Trump's taxes.
He's paid nothing in federal taxes.
I know people that are making a tremendous amount of money and paying virtually no tax.
I pay no taxes. That's why Trump pays no taxes.
But the question that we are left with is, how do they do it? How can they legally avoid paying taxes when we know how aggressive the IRS can be? If you like videos about business, money, and psychology, make sure to subscribe and hit the bell button to not miss any overvalue-packed videos. In order to understand how the rich avoid taxes, it is important to understand that not all income is created the same, and each one has a different set of rules that allow people to keep more of what they made. To illustrate this, let's use Robert Kiyosaki's cash flow quadrant. This explains the 4 different types of income and how they can be taxed. First, we have the employee. This person works at a job and has a salary. Employees typically do not get to choose their income and have very little control over their taxes. Their taxes depend on their income, ranging from 10% for low-income workers under $9,700 and goes up to 37% for high earners with an income over $510,000. Now, on top of that, there are state taxes, which depending on the state, you will have to pay an additional tax. There are some states in the US that don't have any state taxes like Nevada or Washington, but there are others that go up to 13% like in the state of California. A common misconception many people have is that if they earn even $1 more of their tax bracket, their whole income will be taxed at that new bracket. But that is not true. Only the amount that went over the tax bracket will be subject to that tax percentage, not your total income. I know this can be a little confusing, so here's an example. Let's say that your income is $42,000 for the year. This puts you right over the 12% bracket onto the 22% tax bracket for federal taxes. This does not mean that your whole income is taxed at 22%. $9,700 of your income will be taxed at 10%, $29,775 will be taxed at 12%, and only $2,525 will be taxed at the 22% rate. Only the amount that went over the tax bracket gets taxed at that percentage. Now, even though most employees have very little control of how they are taxed, there's still a few things employees can do to decrease their yearly tax bill. A common way workers in this category lower their tax bill is by investing their pre-tax earnings into a retirement account, like a 401k or an IRA. This lowers their taxable income, potentially putting them in a lower tax bracket. Now, this method does not eliminate taxes. It only defers the taxes for a later date when the money is accessed when they retire. Now, assuming that at retirement age, the workers won't have as big of an income, they might also fall into a lower tax bracket, making the total taxes paid to also be lower. The second way people make money is through self-employment. This person has more control over their taxes since they are able to write off business expenses, which can lower their taxable income. But people who are self-employed also have to pay what is called the self-employed taxes, which is another 15.3% on top of the regular federal and state taxes. Normally, when you work on a job, your employer is responsible for paying half of those taxes, and you're responsible for paying the other half. But since you are self-employed and you act as both the employer and the employee, you are responsible for both sides of this tax expense. So let's take a look at how much you would pay in taxes on a $250,000 income without any deductions. With a self-employed income of $250,000, this would put you in the 35% income tax for federal taxes. This means that you would pay $54,367 in federal taxes. But we're not done yet. Let's say that you live in the state of Oregon, where there's state taxes. Due to your income, you fall into the highest tax bracket of 9.9%, which means you will pay $21,195 in state taxes. But you are self-employed, which means that you will also pay self-employment taxes, adding another $23,174 to your tax bill. At the end, you end up with a tax bill of $98,738. This means that out of the $250,000 you made, you get to keep $151,221, making your tax liability almost 40% of your total income. That is, if you did not take any deductions. One of the benefits of being self-employed is that you are able to write off any expense that you might have that is related to your business. For example, if you are self-employed and you have a home office, you'll be able to write off a portion of your rent and utilities as a business expense. If you drive for business, you're able to write off your mileage, or if you lease a car, you might be able to write off the entire lease cost as a business expense. There are other things like insurance premiums or things like travel, food, transportation, and even your clothes. If it all can be related to your business, it can be written off as a business expense. What this does is lower your total taxable income, which helps you pay less in taxes. In other words, you are allowed to spend money before the government takes their share. There are a few tax benefits on this side of the quadrant, but the big tax breaks are done on the right side of the quadrant. The third way people make money is through a business, what Kiyosaki calls a big business. People in this category make use of legal entities such as corporations to host and run their businesses. The tax structures for corporations are a little bit different than the other two categories. In this category, companies can enjoy a variety of different tax benefits. For example, Elon Musk is leading in solar energy research with his company Tesla. The company is able to get a research and development tax break. If your company creates housing for low-income individuals, you might qualify for the low-income housing tax break. There are many tax breaks that corporations can take advantage of, and with the new tax laws signed by Donald Trump, gave corporations a tax cut from 35% down to 21%, making it easier for corporations to lower their taxable income down to 0%. Companies can also make use of debt to lower their tax bill. Many companies borrow money to pay expenses, assets, or build real estate or other investments, all while using their debt to offset their profit. If you are making money with your business and you buy an asset with debt, which is tax-free, you're able to use your profits to pay your debts, lowering your taxable income while increasing your equity on your assets. You're able to turn profits, which would be heavily taxed, into asset equity virtually tax-free using debt. Now, there are a few other strategies that corporate owners do to pay less in taxes for their own personal income. For example, if you own a corporation, you can pay yourself a salary which is taxed like regular income like any other employee, which can go up to 37%, not including state taxes. But what if you pay yourself a small salary and instead you pay yourself the majority of your income in dividends or distributions, which are taxed at a much lower rate? Now, there are laws in place to avoid corporations abusing this strategy, stating that you must give yourself a reasonable salary. Giving yourself no salary while taking all dividends can actually be illegal. So make sure to consult with a good CPA in order to make good tax decisions and not break any laws. Now, dividends and distribution taxes top off at 20%. This means that the portion you pay yourself in dividends will only be 15% if you make under $434,000 or 20% if your income is over the $434,000 mark. Also, dividend income is not subject to self-employment tax, so you'll be saving around 15% in self-employment taxes alone. Now, as you can see, some of the biggest tax breaks happen in the right side of the quadrant, in the business side as well as in the fourth category, which is the investor side. Now, just about anyone can take advantage of some of the tax breaks that the investing category offers. For example, if you are an employee or self-employed, but you saved and invested in real estate and you sold your property at a profit after holding it for 1 year, you can take advantage of the capital gains tax, which states that as an individual who held an asset for over a year can pay down to 0% in taxes if your total income is below $38,600 and maxes out at 20% if you make over $425,000. But if you reinvest the profits back into real estate, no matter your income, you will pay no taxes at all. This means that you can turn your profits into equity without having to pay any taxes. Now, many entrepreneurs use their business's income to fuel their long-term investments. This way, they're able to take advantage of both corporate tax breaks as well as investor tax breaks. For example, if we think of how McDonald's makes its money, we think of burgers and fries. But in reality, McDonald's makes its money with real estate, not with burgers. See, McDonald's is a franchise, meaning other people can own and manage the McDonald's restaurants as long as they follow the structure set by the McDonald's Corporation. McDonald's used their early business cash flow to buy real estate where the restaurant resides. Each McDonald's franchise owner is like a tenant paying McDonald's rent, not only to use their brand and business model, but also to rent their building. This makes McDonald's the landlord and the franchisees the tenants paying rent. The tax code is extremely complex. Always make sure to check with a qualified professional before making any financial or tax decisions. This video is not meant as financial or tax advice. If you enjoyed this video, make sure to give it a thumbs up for that YouTube algorithm, and as always, thank you for watching, and I will see you in the next video.